Welcome to our video on whether you should pay off low-interest loans early, especially around the 3% mark. We will explore both the analytical and psychological dimensions, evaluate opportunity costs, and build a balanced strategy. Let's begin with what we'll cover today, and then we'll set the stage with a clear definition of the dilemma. Here is today's agenda. First, we will define what a 3% loan implies. Next, we will analyze why liquidity often wins from a purely financial standpoint. Then, we will explore the emotional case for paying off debt early. After that, we will unpack opportunity cost and the role of emergency funds. We will then walk through a practical, actionable strategy and a decision tree. Following that, we will compare quick scenarios. We will also pause for short quiz checkpoints to reinforce learning. Finally, we will wrap up with key takeaways and next steps. To set the stage, a loan with an interest rate around 3% is generally considered inexpensive. At the same time, high-yield savings accounts and certain low-risk instruments often pay more than that. Therefore, paying off a 3% loan ahead of schedule may not be financially optimal. Still, money decisions are not purely mathematical. Emotions, habits, and peace of mind play a role. With that context, let's move into the analytical case first, and then we'll contrast it with the psychological view. In the analytical case, liquidity is the priority. A 3% loan represents cheap money when you can earn more than 3% with relatively low-risk alternatives like high-yield savings. The key principle is opportunity cost. Every additional dollar directed to early repayment is a dollar that cannot earn a potentially higher, safer return elsewhere. Furthermore, an emergency fund of 3 to 6 months of expenses should come first to protect against unexpected costs. If your after-tax net yield on savings exceeds 3%, you are financially better off maintaining cash and investing the difference rather than accelerating a low-interest payoff. Next, to make this more concrete, let's talk about the math of opportunity cost. Opportunity cost is the difference between what you could earn and what you actually earn. For example, if your high-yield savings account pays 4.5% and your loan costs 3%, the spread is about 1.5% in your favor by keeping funds invested instead of prepaying. Always consider after-tax returns. If your after-tax yield is still above 3%, you are ahead financially. Additionally, retaining cash means you can handle emergencies without resorting to expensive credit. With the math in mind, we now need to balance this with the psychological comfort of being debt-free. From a psychological standpoint, paying off a 3% loan early guarantees a 3% return. That certainty can be appealing for conservative investors or anyone fatigued by market volatility. Removing a monthly payment also provides a behavioral advantage by freeing cash flow, which can be redirected to savings. Finally, mental peace has real value. Even when the numerical differences are small, the emotional relief from being debt-free can improve decision-making and well-being. To navigate these competing forces, let's map a decision path. This flowchart begins by asking whether you have a fully funded emergency reserve of 3 to 6 months of expenses. If not, it directs you to build the emergency fund first. If yes, the next step compares your after-tax yield in a high-yield savings account to the loan interest rate. If the after-tax yield exceeds the loan rate, the chart recommends paying minimums and keeping funds invested. If the after-tax yield is less than or equal to the loan rate, it suggests considering targeted prepayments. A parallel branch assesses psychological preference. If you experience high stress about the debt, the chart allows for partial prepayment while maintaining a minimum emergency fund threshold. The outcomes include 3 paths: maintain liquidity, partially prepay, or accelerate payoff with a plan to rebuild savings. On the left, the analytical approach emphasizes paying minimums on low-interest debt, allocating excess cash to higher-yielding vehicles, protecting a robust emergency fund, and focusing on long-term net worth growth. On the right, the psychological approach prioritizes early payoff for certainty, a guaranteed return equal to the loan rate, simplified cash flow, and reduced stress. The right choice depends on your tolerance for risk and your need for liquidity. With the comparison clear, let's convert this into an actionable plan. Here is a balanced playbook. First, secure your foundation by building and maintaining an emergency fund of 3 to 6 months of expenses in a high-yield savings account. Second, always pay at least the minimum on your loans to avoid fees and protect your credit. Third, if you want to speed progress without compromising liquidity, make targeted, principal-only extra payments. Fourth, if your after-tax savings yield exceeds the loan rate, Automate transfers so the yield spread consistently benefits you. If you anticipate a tax refund or bonus, consider a modest prepayment, and then replenish or top up the emergency fund when the cash arrives. Sixth, review your plan quarterly to reassess yields, rates, and stress level, and then adjust as needed. Next, let's ground this with a few quick scenarios in a table. This table presents 4 scenarios. In scenario A, the after-tax savings yield is 4.2% versus a 3% loan, with a full emergency fund. The suggested lean is to pay minimums and allocate the spread to savings or investments. In scenario B, yields and loan rate are close, suggesting either path could be reasonable, with behavior and stress as the deciding factors. Scenario C shows a high yield but insufficient emergency savings. In that case, prioritize building the emergency fund first. Scenario D includes a full emergency fund and a favorable yield but high stress. There, a partial prepayment can provide peace while preserving the buffer. Now, let's check your understanding with a short quiz. Quiz time. Question: before making aggressive prepayments on a 3% loan, what is usually the top priority? Options are A. Maximizing retirement contributions, B. Building a 3 to 6 month emergency fund and a high-yield savings account, C. Refinancing to a shorter-term loan, or D. Consolidating multiple debts. You may pause the video now to think about the answer. We will discuss the answer in the next section. The correct answer is B. Building a 3 to 6 month emergency fund in a high-yield savings account is usually the top priority before accelerating prepayments on a low-interest loan. This protects you from unexpected expenses and reduces the risk of needing to borrow at higher rates later. Next, let's try one more quick question about opportunity cost. Second question: if your after-tax high-yield savings yield is 4.5% and your loan rate is 3%, what is the opportunity cost of prepaying instead of saving? Options are A. About plus 1.5% in favor of prepaying, B. About plus 1.5% in favor of saving or investing, C. 0, or D. Impossible to estimate. You may pause the video now to consider. We will discuss the answer in the next section. The correct answer is B. The approximate 1.5% spread is in favor of saving or investing instead of prepaying, given those rates. That represents the foregone return you would miss by sending extra dollars to a 3% loan rather than keeping them in a 4.5% account. Next, to reinforce the plan visually, let's look at a pie chart of a sample monthly cash allocation. This pie chart illustrates a sample monthly allocation. Half of monthly cash flow goes to essential expenses. 20% goes to minimum debt payments. 15% is directed to the emergency fund or high-yield savings to maintain liquidity. 10% captures the savings or investing spread when yields exceed the loan rate. The remaining 5% covers discretionary spending. Your numbers will vary, but this breakdown shows how you can both meet obligations and build liquidity. Next, we will show a brief timeline from carrying low-interest debt to achieving peace of mind. This timeline shows a progression. In the first month, audit finances and confirm your rates and yields. Over months 1 through 3, fully fund your emergency reserve to 3 to 6 months. From months 3 to 6, automate minimum payments while directing the yield spread into savings or investments. Between months 6 and 12, if debt-related stress remains high, consider partial prepayments while preserving your buffer. After 12 months, reassess rates and your stress level, and adjust allocations while maintaining the emergency fund. Before we wrap up, let's include a concise Markdown recap you can screenshot. Here is a Markdown-style recap. First, rules of thumb. Keep 3 to 6 months of expenses in a high-yield savings account. Favor liquidity when your after-tax yield exceeds the loan rate. And if stress remains high, allow a partial prepayment while preserving the buffer. A simple check example shows a 3% loan rate, a 4.2% after-tax savings yield, and a spread of about 1.2% in favor of keeping funds in savings. Finally, the Pay Yourself Back plan suggests that if you eliminate a small payment, you should redirect that same cash flow to rebuild savings quickly. Now let's distill the most important ideas into key points. These are the key points. Liquidity provides protection, and a 3% loan is cheap relative to many current yields. Opportunity cost is central. Avoid giving up higher safe returns. Always prioritize building and maintaining an emergency fund. If your stress level is high, partial prepayment is a sensible compromise. Finally, Review your plan quarterly and adapt to changing rates and circumstances. Next, we will summarize the bottom line and your next steps. Here is the bottom line. When after-tax yields exceed your loan rate, financial optimization favors paying minimums and investing the difference. From a behavioral perspective, if peace of mind is a higher priority, a partial or full prepayment can be appropriate, provided the emergency fund remains intact. Do not sacrifice critical liquidity for small interest savings. Ultimately, the right decision is the one you can maintain consistently while preserving your ability to sleep at night. Before we close, a brief disclaimer. Disclaimer. This video is for educational purposes only and does not constitute financial advice. Your circumstances may differ significantly. Consult a qualified professional for personalized guidance. Now, let's wrap with a thank you and a quick request. Thank you for watching. If you found this helpful, please like the video, share it with a friend who is debating early payoff versus liquidity, and subscribe for more practical money frameworks. Drop your thoughts in the comments. Are you team liquidity or team debt-free, and why? Your perspectives help others learn. See you in the next video.